Hi, and welcome to SpotGamma's Introduction to Equity Trading video. My name is Matt Fox, and along with our lead innovator Brent Kachuba, I am a co-founder of SpotGamma. Here at SpotGamma, our goal is to provide you with unique information around stock movement based on our evaluation of the derivatives markets. SpotGamma is an information-only site, and nothing contained in any of these videos constitutes investment advice. If you are going to be making investments, please consult a professionally licensed investment advisor before making your independent decisions. During today's discussion, we will cover many of the basics. If you already have a firm grasp on the mechanics around how to trade equities, who else is in the market, and why different trading approaches matter, please feel free to move ahead to our next video. Also, while much of this introductory training information is available on other websites, our educational series is aimed at reviewing the basics around stocks in the context of the SpotGamma product, and this theme is carried throughout our videos. In terms of defining a stock, I would like to start by taking one step back and describe what it means to evaluate a stock from the perspective of a company and SpotGamma. When it comes to running a company, corporate management teams have several ways to fuel their growth. A couple examples include generating revenue from existing operations and issuing debt to investors. However, for the purposes of this SpotGamma-centric introduction, the most relevant way for companies to get access to capital is to issue stock. This stock, which will likely trade on a public exchange such as the New York Stock Exchange or NASDAQ, represents a small ownership of a company. Therefore, even those with 10 shares will receive the same return and financial treatment as anyone who owns 10 million shares of the same stock. To provide some additional examples below, please look at these familiar logos. Companies that issue stock can range from one-product biotechnology enterprises to large retailers. Here at SpotGamma, our analysis and insights do not meaningfully change for the stocks we analyze based on a company's financial structure, a topic we cover later in this discussion around technical versus fundamental analysis. What does matter is that these stocks have a meaningful volume of trades every day, and their listed options have significant trading flows. Please keep these concepts in mind as we now discuss what it means to buy a stock. Now that we have defined a stock and understand that SpotGamma focuses on publicly traded equities, we can review what it means to buy a stock with the expectation that it will increase in price. Let's take Apple as an example. Unless you've been living under a rock, you've been pounded with advertisements on billboards, football game commercials, and online ads to buy Apple products ranging from iPads to iPhones. Now, let's assume you bought the new iPhone 12 and think its features are really impressive. So using a brokerage account, such as Schwab or Robinhood, you decide to buy 10 shares of Apple, which requires you to spend $1,150 on their stock, $115 times 10 shares. Next, let's assume that over the course of the following 2 months, that Apple management provides updated guidance that they have seen increasing demand for the iPhone 12, and their sales have exceeded expectations. As a result, Apple stock goes up to $125 per share. As an investor, you can then make the decision to sell the stock at $125, returning roughly $100 of profit, 10 shares times $10. Keep in mind, if the opposite were to happen, where the stock would decline in value, you would be losing $10 per share on every dollar of stock price Apple goes down. Again, purchasing a stock results in risk, and you are investing with an expectation a stock will appreciate in value. Last thought for this slide, before turning to short selling, is that when looking at this chart, you can see there are technical levels provided by SpotGamma. These levels represent our unique insights and suggested prices where additional buyers and sellers may enter the market. We describe these levels and how they can be very useful in more detail in our intermediate and advanced videos. Having just described what it means to buy a stock you believe will go up, and then sell that same stock to close out a position, we will now describe the opposite, how to short sell a stock when you believe a stock will go down. The act of short selling may seem confusing, but for the investor, it really is straightforward. Instead of buying a stock you don't own when you make a traditional investment, you sell a stock you don't actually own. Mechanically, this works because your trading platform or a bank will technically lend you the stock to go sell in the open market, with the promise you will buy back the stock in the open market later and return to the bank to close out the trade. As an example, let's again take the Apple stock price at $115. In this case, let's assume you believe the new launch of the iPhone 12 will be a flop because Samsung has a competitive product that is far superior to Apple. So you short 10 shares at $115. Next, Let's assume that over the course of the following 2 months, that Apple management provides updated guidance that they have seen decreasing demand for the iPhone 12, and their sales have failed to meet expectations. As a result, Apple stock goes down to $105 per share. As an investor, you can then make the decision to buy back the stock at $105, returning roughly $100 of profit, 10 shares times $10. Keep in mind, if the opposite were to happen, where the stock would increase in value, you would be losing $10 per share on every dollar of stock price Apple goes up. Again, short selling a stock results in risk, and you are investing with an expectation a stock will decline in value. As with the slide where you are buying a stock, our SpotGamma levels are helpful in this situation because they may provide color around where others are likely to buy or sell a stock due to activity in the derivatives market. When we say others, it is important next that we now define what we mean by counterparty on our next slide. Having covered some of the basics around stock buying and short selling, we will now describe the participants. When you buy or sell a stock, you are often not trading with someone like you on the other side who just happens to have the opposite opinion. Instead, there are financial institutions which stand ready to buy and sell stocks and options being a form of derivative we will cover in the next video. These groups are called market makers. Market makers can be very large banks or independent trading companies that are licensed by an exchange and make money by taking a small amount of every trade. They receive some preferential order treatment in exchange for being required to post a bid, an offer to buy, and ask, an offer to sell, in every stock where they are a market maker of record. Importantly, when they take a position on a trade, they need to protect their position because they are not in the business of making directional bets. They are in the business of getting paid for helping others take directional bets. So, to protect their underlying stock position, they trade options, which we will get more into in the next educational video. SpotGamma has world-class expertise in analyzing the relationship between the amount of options that need to trade in a given scenario in these derivatives markets and their effect on the way a stock may move. These are insights that SpotGamma shares directly with its subscribers regarding any stock on any given day. Next, we will discuss the types of large trades and their potential impact. Building off the last slide covering market makers, we are now looking at the effect of larger trades. In general, this slide is meant to reinforce the concept we just covered. As we have now described in detail, market makers are responsible for providing liquidity to the capital markets. Their willingness to sell you stock or buy stock from you requires them to, again, hedge or protect their position using options. In the case of smaller orders, this results in smaller needs to hedge. In the results of larger orders, this can create a big change in the movement of a stock, resulting in a larger hedge. Regarding these large orders, it is important to know that large investment firms can trade big orders all at once or sell pieces of the orders throughout the day. This helps keep everyone from knowing if there is a large buyer or seller in the market. Another way these funds disguise their orders is to utilize what are called dark pools. These dark pools are set up by banks and aggregate orders from many customers. It is thought that these dark pools give the majority of traders less visibility to these large traders and potentially gets buyers and sellers a better price. Regardless of how these large transactions take place, at SpotGamma, our focus is on looking at all options volume throughout the day in aggregate to assess the amount of options that need to trade in individual stocks, thereby affecting the stock's underlying movement. It is through analyzing these movements that one can get a unique advantage in understanding the required hedging flows, which again is a component of technical analysis, which we will cover next. As we look at the ways investors make decisions, the main approaches are placed into one of two camps: fundamental investing versus technical investing. In the case of fundamental investing, an investor looks at the company, the sector, and the news flow that would affect the stock. Let's take Tesla, for example. A fundamental investor would analyze the revenue, company growth, and competitive landscape as part of an overall analysis meant to arrive at an investment decision. On the other hand, technical investing is the opposite. As an investor, you are not concerned with the dynamics around a company, and instead much more interested in the quantitative aspects around both the price and movement affecting how Tesla's stock is trading. As for SpotGamma, we fit squarely into the technical camp. Our quantitative approach does not attempt to analyze or predict quarterly earnings or news releases. Instead, we strategically evaluate the derivatives markets and provide unique insights into how they affect the movement of a specific stock or index. In the next videos, we will drill down into options and how our proprietary process can be applied to an overall investment strategy. Now that we have provided an overview of buying and short selling stocks, counterparties, the importance of hedging, and our role providing technical analysis, you should have the basis for advancing to our next video on options. As an interested party or potential investor, it is important that you understand these realities around stocks and options before moving into our intermediate video section, where we introduce the concept of gamma. This is where our world-class expertise can make a meaningful difference for anyone looking to analyze stock movement. Thank you for your attention, your interest, and I welcome you to keep learning with us as we share our knowledge here at SpotGamma with you.